G'day guys, welcome to Financial Fruits Part 3, and I'm going to say right now, you may know something different, is that we've got this swanky notepad here as well. Main reason why is from the feedback from my previous videos. People wanted to know, um, basically, hey, can we get some visual stuff as well, because I want to be able to see it. I was actually looking at some PowerPoint presentation, but I think notepad may be the best way to put it. It's like kind of like a blackboard or whiteboard, where I'm just like showing all my explanations and stuff like that as well, and mainly the dot points and cliff notes that you can keep your eyes on as well. Now, overall, before the video begins, none of the stuff that I'm giving at the moment is personal financial advice at all. You got to do your own research and all this stuff at all. Any examples that I use are completely made up by myself, and they do not apply to your personal circumstances at all. Please go to financial advice if you want to do so. If anything, if you do want personal advice and you're within Australia, you can contact me. I can give you personal financial advice, given that I am able to give it to you. It's a private matter, all general. I am a financial planner, authorized rep. So make sure at the same time, I can only advise in Australia. This is not advice at all for you. This is general in nature, factual information only. If it does seem like personal advice, it's not. Okay? I know like all the crypto bros and stuff do this sort of stuff as well, but I'm trying to do it for your own good. Okay? So financial fruits. Okay, so part 3, we talked about assets last time, like just assets briefly, like cash, fixed interest, property, Australian equities or domestic equities, and we talked about international equities. So this is what we talked about. These are the basic assets, which is fixed interest, property, domestic equities, and international equities. So today, we're going to focus on the defensive side. So what is a defensive asset? A defensive asset is one that's not so, what we call it, volatile compared to the market. So for example, like I say, if the share market goes by 100%, the other things don't move too much. Okay, so the main thing we're looking for is we're looking to protect our capital. That's what defensive generally is and generally means. So the ones that you can protect your capital best on, where you get paid a small amount of income, but your capital is mostly protected, depending on how it ends up, is generally cash and fixed interest. Okay, they are your generally two options to protect your capital, and you can receive a small rate of return at the same time. And those are very, 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 very important. Okay, incredibly important, because generally the government does step in, and the Australian government in general has stepped in for cash previously for term deposits and other stuff. There is a government guarantee in place up to a certain amount. You will want to do your research on that. Okay, I do not know the amount off the top of my head, but there is an amount that the government will protect you from. So if a bank does fall over, you got a certain amount of cash that you'll get back. So, and generally cash is generally quite secure in a way that has a very, very low risk of going under. And same with fixed interest as well, given as a debt instrument. The only way that it goes under is if they go bankrupt and don't pay the debts. But you're generally first on the cards to get repaid your debt. If you've, we'll talk about it later about how the debt order works, but we'll go through it in general. We'll go through it. Actually, we'll go through it later today. Actually, so let's talk about cash. So cash, basically, what's cash? Cash is term deposits. Cash account, you got your transaction account. That's cash. Savings account, also cash. Cash management trust. If you guys don't know what this is, so basically there are some trusts that invest the cash into a high interest rate market. That's cash too. So pretty much like anything's cash. So basically, you got your bank card. That's cash. Cash has the lowest return. What are the advantages and disadvantages of cash? Okay, let's go. Advantages of cash. Well, one thing is it's secure. Government guarantee. What else? Oh, very liquid. Okay, very liquid. This is gonna be big, big thing later on about how liquidity is so important. Okay, you understand how liquidity is so important when I can say right now, if you're in retirement or if you are not earning an income, you see how important liquidity is. Okay, so secure, government guaranteed, liquid. I don't know any more advantages about cash. What's the disadvantages of cash? Okay, disadvantages of cash. Well, I can tell you right now, cannot hedge against inflation. What else? Low returns. It basically so I guess put in VARs. You can't hedge against inflation because if the cash inflates, you're not protected. Low returns and low interest rate environments. I can tell you that the inflation one's a big one at the moment. It's the reason why cash is underperforming is because inflation is 7% and your interest rate's returning like 1%. You're losing 5% basically each time. And yeah, that's the worst part about cash. But that's the disadvantage of cash, okay? Is they can't hedge against inflation, low returns and low interest environments can be illiquid if in TD due to break costs. Now, with breaking a TD, a term deposit, or it could be a CD as well in some areas, a term deposit, which we're going to highlight up here, a term deposit is basically you keep your money with a bank for a certain period of time, whether it be 3 months, 6 months, 9 months, 12 months, 2 years, whatever. You know, basically a lot of banks offer these. And you get a higher interest rate than you would get in a cash account because it's based on a different cash rate. Overall, or not different cash rate, but it's based on the government or RBA or whatever your reserve bank is cash rate, okay? And it's just a calculation from it all. Now, those will pay a higher interest rate, and it can be highly illiquid because if you take out the term deposit, there is generally a break cost involved, or you just lose the interest, which can make it a bit illiquid or a bit hard to take out if it's in a term deposit. Unless, you know, it's a quick term deposit, you can take it out and only take a, you know, small break cost. But overall, before I delete this and talk about fixed interest, actually, you know what? I wonder if we can go down a bit. No, you know what? We'll keep this up for a bit. So basically, the advantage for cash is just it's secure, government guaranteed, liquidity. Can't hedge it against inflation though. Low returns and low interest rate environments can be liquid, you know, if you're in a TD. Now, the most important thing as well with cash, sometimes cash is king. Okay, cash is king because in a really, really bad economic cycle, cash can be king. So that's another advantage as well that we forgot. Can purchase assets. Well, you can purchase assets. You can purchase assets at a much cheaper price. But also the opposite is also true. That's bad in upturns because you got to invest that cash at potentially a higher price when you're buying shares, which is also a downside of cash. But anyways, I digress. But anyways, we'll keep these up for a few seconds. So, you know, I'll be talking about a few things as well. Next up, we're going to talk about fixed interest. So fixed interest is a different kettle of fish. We'll delete the cash at the moment, so you guys get the cash. I'll put some timestamps in here so you guys can see it. Fixed interest. So fixed interest is actually a whole bundle of stuff. So fixed interest can be bonds, let's say corporate bonds. And you know what? We'll just keep it bonds, okay? Then you got credit, so mortgages. That's an example. You know, we'll just put it up here. We'll just put it up here, like, you know, corporate bonds. What else for fixed interest? Hybrids. Hybrids are basically debt equity, can be traded on market. We'll just put can be traded. So what else? What other things are? I think I've got most of the fixed interest off. There's also, oh, that's right, you know, floating notes. I forgot about banknotes. Floating fixed. But I think I've covered a lot of them off, okay? So generally, the fixed interest, what they have in nature of fixed interest is that they generally have, so let's go through a fixed interest asset. A fixed interest asset generally has a rate of return or interest rate. People call it coupon rate. So basically what the coupon rate is, the coupon rate is basically a risk premium in it and also the risk-free rate. Now, the risk-free rate is generally the cash rate of your RBA, okay? And the risk premium is the risk of the company that you are investing in, okay? So if you think the company is super risky, that risk premium is going to be a lot higher. But if the company is not that risky, the risk premium is going to be a lot lower. It also depends on the rank of debt, okay? So senior equal lower and junior equal higher, okay? So you get junior debt, you want more, okay? Because you take, basically, you know, if the company does go under, you're not on the top of the pecking order of getting your money back. So that's why they have a coupon rate. They also have a duration. So duration is generally how long until you get your money back. Okay. Now, the reason why I say that is that we should probably get it up first of all as well, is that with the bonds, most bonds is effectively you lending money to a company, and they paying you a coupon rate, and then they pay you the value that you gave to them. Let's say you gave them 10 grand, and then they give you 5%. You get that 5% every annum, say it that way, and then they give you back your 10 grand after 5 years. Okay, that's pretty much how most fixed interest assets work. It's basically you lending money. So duration is how much you want to get back, how long you receive coupons for, how often you receive it. So basically, for coupons, you can actually receive it like every quarter. So you receive quarterly, half yearly, yearly, even I think monthly as well for some assets. So those are the main processes of a fixed interest asset. Is that there's a duration, there's a coupon, there is a par value, and the par value, I can tell you right now, with most of these bonds and stuff like that, is $100. So trading at par is $100. So these bonds can go up and down, but the par value is $100. So basically, at the end of the day, you get $100 per Fingo back. Bonds can be a lot more. Par value is generally for hybrids. Bonds and other stuff as well is a lot higher. I just realized I spelled hybrids incorrectly. But anyways, I digress. But you can see that hybrids and bonds and all that stuff, the credits can trade in like 10 grand, 100 grand, and stuff like that as well. So that's effectively a fixed interest asset. Like I say, overall, that's a fixed interest asset. So we won't go through the calculations that they do and stuff like that. You just got to be aware what sort of asset it is. Okay. Now let's go through the advantages and disadvantages of a fixed interest asset. So advantages of fixed interest asset. That you get paid. You get paid a decent coupon. No, you get paid. Sorry, what's the advantage of it? Income. You get income from it. A lot higher than cash, generally. What else? High on, debt ranking. If company goes bust. What's another advantage? Oh, another advantage is if int rates go down, and you're on a fixed rate. As I said, it can be fixed or floating, by the way, guys. Fixed or floating. Some hybrids have both, but you can have a floating rate bond, which goes up with interest rates, or a fixed rate bond, which doesn't fluctuate. So basically, if int rates go down, like if rates go up, more profit, unless fixed. If int rates go down and you're fixed, it's good too, because you're getting more back than the market incurs. I'll just put float here as well, so people understand. What else can you do? If hybrid can trade on market, generally with the fixed interest market, it's very hard to trade on market with bonds, credit, corporate bonds, and stuff like that. There are certain entities that are trying to bring this more into the market where you can trade bonds on their stock exchange to make it more liquid. Okay, so this is one of the disadvantages as well. Overall, fixed interest assets have gone on to a long evolutionary process to try to get them on the market. Now, disadvantages. The flip side is obviously as well, can be illiquid if bonds and credits, due to the old-fashioned nature of it. That's one thing. Can be liquid, okay? Hybrids are excluded. I can put hybrids not. Now, if int rates go up and you're holding fixed, bad for fixed, okay? If int rates go down, bad for floating, okay? So you get less. Now, like I say, even though you're high on the debt ranking, generally, if company goes bust, unless it's tied to an asset, you get very little money back. Now, overall fixed interest as well. That's right. Capital unlikely to increase, okay? Very unlikely for your capital to increase, okay? The main reason why, I put up here, unlikely to decrease as well. is that generally fixed interest assets stay close to their par value, and the only things that move them up or down is if the business is significantly a lot better or significantly a lot worse, or the interest rate itself on other assets are a lot higher compared to the ones that's being offered at the moment. Now, overall, as you can see, these risks are pretty minimal, and most companies that issue their debt actually peg themselves generally against other debt on the market and offer just a little premium above. These sort of things generally do not occur too much, so just be aware of that as well. So the prices of fixed interest assets won't fluctuate. So if you're expecting a capital return, you're not going to get it here. You're not going to get just stable income or steady income across the duration of the bond and the bonds hybrid or whatever. But anyways, guys, that's gonna be it for today. I've talked about 16 minutes about fixed interest in cash. Overall, fixed interest in cash, they're just basically really defensive assets that pay income to you, and your capital somewhat or a bit secure. At most instances, okay, they try to, your main opportunity is to secure your capital and not and earn some income along the way, not to try to go for capital growth or any of the big stuff either. You're just trying to go to just get a quick income, keep your capital safe, and that's pretty much what fixed interest in cash is for. Generally, for people who are over the short term, let's just say over probably about 1 or 3 years, generally is what cash and fixed interest are for, because you keep your capital stable, and it's a short term goal basically. Like your capital won't be affected too much by investing in these assets. Okay, but it can be, of course. Okay, it can be. But anyways, guys, that's gonna be it. Like, comment, subscribe if you enjoyed this part. I know it's a bit of a long part. Problem is, part 4 is gonna be a bit longer, but I'll try to make it short and condensed, but split it up into extra parts as well. But anyways, guys, thank you guys and have a great day. Peace out.